Hello, hello, hello. Welcome to Al Stock Trades. It has been a minute since we've guys, since I miss you guys. It's been a while since we talked. I just recently moved from Minnesota down to Arizona, and it's been really hectic, but I'm trying to get everything patched together. I also have a big exam I'm studying for. I'm currently here in Scottsdale, Arizona. Great coffee shop here in the Valley. And I wanted to make this video for you guys as a study break, but also keep you informed. This is going to be a mega video, since two-part series, part 1 and part 2, since we haven't talked in a while. This will focus on some beginning stages of Clover Health regarding some things that I found in continuation from our discussion from the All In podcast. Second, we're going to look at market indicators. These are important things to look at as the market is heavily connected together. And then series 2, part 2 of this video, will look into, will be a different upload, will be support resistance levels of Clover, and so on and so forth. Okay, so last time, and by the way, for the people that are on our Discord channel, Brain Machine, we're working on it really hard. We're removing all the bugs to make it a very smooth AI interface. It'll be beautiful, and I can't wait for you guys to see it. So, all right. So if you, from our last continuation of the All In podcast, we had Chamath ask David Sachs that one of his companies booked a $40 million just on accident for their SaaS. They went into SaaS, which they don't normally do SaaS. And the more I think about it, the more Clover Health just hits it. It just seems that this might be Clover Health. And I know I'm speculating, but I just can't help seeing David Sachs. And again, this is the official Clover Health page with regards to the company here. And I just can't help but to see Jason and David Sachs for looking into Clover here. And again, Jason is really good for startups as well, but David Sachs is the taker, the former CEO of PayPal, the creator of Yammer, and just a really phenomenal individual that I like to gear up with the alpha thinkers. With Peter Thiel, Mark Zuckerberg, Chamath, Elon Musk. These are really forward thinkers that they have good predictive models that I just like to really listen to and jump off ideas from. So I really do look up to them. So I do see that David Sachs is following Clover Health, and it just so happens to be that on April 11th, Clover Health reported that they're going to do their Q1 of 2022 financial reports, which is good because it'll be forward-looking. And if it so happens they went ahead, and if they did say that we got $40 million in SaaS, then for people that don't understand what that is, it's subscription. It's almost like it's just the profit margins for that. It's almost licensing the Clover Assistant platform, the AI that they have for the machine learning. If they do that, guys, the model is going to change. The business model is going to change. The revenue multiples are going to change. By the way, I'm at a coffee shop, so if you hear any sound in the back, my apologies here, okay? But I'm going to keep going and keep powering through this, okay? So what's interesting here, when I was at this coffee shop yesterday, there was a CFA, a chartered financial analyst. These are the top of the top, the creme de la creme. I heard a conversation he was having, and then we went ahead and talked, and we talked about Clover Health, and he said, no, honestly, I don't really, Chamath, now, you know how it is for people that have been following Clover Health. And we talked, and I was like, you know what, they might change into a SaaS. And he said, I heard about that $40 million. And I was like, wait a minute. So you know about it. So word on the street, people are starting to connect the dots. And I think word on the street, people are this guy's been a chartered financial analyst for about 20 years. And this is a very good area. This is one of the wealthiest areas in Arizona. It's very interesting to see that. This may be Clover. And again, I'm speculating now, but this may be Clover. Okay. And if it is, holy freaking moly, boy, we have to redo our analysis, and we got to look into some things here. Okay. So, but we already anticipated this. We already know they're going to end up being a SaaS in the future. It just happened earlier than what I was expecting. But we'll look at it, and this will be the day. May 9th will be the day. And again, they were supposed to be reporting May 15, May 14, May 15-ish. And for them to report early, that's really good. That's a tall tale sign. MIT core study, they studied all financial earning reports for companies that are traded on the stock market. They found that if you report a little earlier, it signifies that it's doing pretty good. Okay, so there's a lot of good stuff. And I also spoke to him about some other stocks that I talked, like Marvell, and he gave me a really good compliment. I mean, now I've been doing this for 10 years, but I mean, I'm not like a professional, right? I'm not like I'm going to go into my dream job is neurosurgery. That's where I'm at my most happiest, is in the operating room. So that's my dream job. But to have someone to say, hey, man, for you to know these stocks, you're definitely in the top percentage of analysts, top analyst, better than the top analyst on Wall Street. And for him to tell me that, that's and he's he's definitely, he has a lot of gray hairs on him, so he's been in the game for a while. And for her to hear that, that's really, I like to be humble, but honestly, that it feels good to be noticed. Okay, so there's what I have to say for here. So now let's make me smaller here. Let's kind of put me here where I don't interrupt you guys with the education here. So this is smart money, dumb money. Again, the blue is essentially institutional investors, and the red is essentially retail investors, dumb money, right? And as you can see, when February and March was happening, retail was selling, right? And then the institutional investors, they were buying. They were essentially buying the dip, right? And unfortunately, this is what happens, right? When the stock goes down, retail sells, institutions pick it up, they hold it and pass it on to retail once the stock goes up. And, retail thinks stocks continue going up, and they just keep doing that, and then the cycle continues. The rich get richer and the poor get poorer. And Chamath talked about that. If you have access to data that shows you when retail is buying and selling, you tend to profit in the market, right? And so that's this right here. But so this is a way to look at it. But an easier way is to take a look at the let's go here. In fact, give me one moment. Let me make this a little bigger. It's cutting off, and I want to, for some reason it is cutting off, but it's fine. Want to make it perfect for you guys, but let's go back and take a look at this. So if you look at the smart money and dumb money confidence spread, for people that don't know, this is just looking at the ratio. It's a bit easier to understand than just your simple smart money and dumb money. If you look at the spread here, it's a ratio. So smart is on top and then dumb is on bottom. So the higher this number goes, the more smart money is buying. And as you can see, smart money was buying heavily here when the market dipped, right? But then all of a sudden now, it's the spread started to go down. And because of that, it means the ratio is going down, which means that dumb money is buying more than smart money, hence why it's inversely proportional. So now we're starting to see a rebound in smart money coming back in, which is exactly what this is here, while dumb money is basically doing the opposite. So again, follow the smart money, but also you should also follow the dumb money and do opposite of them as well. And it's not as simple as that. You got to go in to do other analysis, but there's just so many ways to evaluate. This is just one doing a macro analysis here. Okay, so this is the bear market probability model. And this is a really good one that Goldman Sachs put it together. And it looks at the U.S. unemployment rate, the ISM manufacturing index, the yield curve, the inflation rate, and the PE ratio. And as you can see, we're at levels that are extreme bearish. And we haven't seen this since 2008. In fact, we're even higher. We're higher than 2008 levels. So things are really out of whack. I would say it's the inflation rate that's dragging things up. Honestly, we're definitely thinking about heading into a recession. The question is when? When is that recession going to come? And we'll talk about this in this video. But as you can see, we need to fix inflation. And we also need to fix this war that we have with Ukraine and Russia. Okay, so now we're looking at the fear and greed model. This is derived a little bit from the CNN market sentiment indicator. This is extreme fearful, which is good. That's why I put a smiley face. You want to be greedy when others are fearful, and you also want to be very fearful when others are greedy. And now we're approaching a very greedy market right now, where people are just saying buy, buy, buy. But it's kind of weird. Some stocks are really great, and other stocks are at all-time lows. And now I believe we're heading towards a market where it's going to be Wall Street's going to have to decide. The market's going to end up punishing companies that do not report really well and that project their amazing profitability out to 2025, 2026. But companies that are projecting profitability a little sooner, they're going to be rewarded. So we're at a market now where we really need to start focusing on our balance sheets, our free cash flows, our net incomes. And Clover Health understands this, and they're ahead of the game. Okay, so there's that. Now let's go ahead and talk about the Eurozone retail sales. Now, for all this talks of recession, retail has honestly been a really great through all this pain. I mean, they're buying retail. They're trending up higher. However, we still have April and May, and we may see it go down. But this is a great indicator to look at, as you can see, with 2020 when the world economy shut down. We have 2008 with that dip going on here. This is great, essentially, to look at the market sentiment of Europe. And again, I think Europe has a higher level of a recession than the United States. And with the whole China locking down, it's almost like China wants Europe to undergo through a recession. So these are really important things we got to discuss to get an understanding of the global economics, because what we found out through the 2008 financial crisis is that all markets are interconnected. We got to look at Europe too. So this is the economic sentiment indicator for Europe, and this is the breakdown per country. If you're interested, I'm not going to go over this one too specifically, but the reason why I like this one is it tracks really well with GDP. As you can see, real GDP is in blue, and you can see that this economics indicator tracks extremely well with the real GDP. And as you can see, it's starting to trend downwards, okay? That's not good. We want gross domestic product to be high for Europe, but it's not looking good right now, and we're going to look at, only time will tell where we go. But from this indicator, it's going down. And do I blame the European people? No, I do not. They're very close to the Ukraine and Russian war right now. It's close to home. And with Putin just basically saying that the talks are not going anywhere and they're dead in the water, well, hey, things are going to, unfortunately, not be good for Ukraine. Okay, so there's that. Now, if you look at car production for Germany, it has been decreasing, as you can see, as it going down. And this is all due in part of supply chain issues, car parts shortages, and now the Ukraine problem with Russia that we're having. These are big problems here. And I think that we're definitely heading down with this, and hopefully we can get to a level where we can sustain global trade as supply chain and all the part shortages keep us at bay, with the whole China locking down with Shanghai. Okay, so I'm going to talk a little bit more about this graph. This graph is very important. I'm going to try to do it really quickly. You may have to watch this video again. I recommend it. This is good education here. This is called the Purchasing Managers Index. It's extremely useful. It takes a look at production levels, new orders, supply deliveries, inventories, and employment levels. And let me just remove my face here. Let's put it here. Whenever you see an inflection down below 50%, it means that the economy within China is starting to contract, okay? As you can see here, right? But where did I go? Add camera. Sorry about that. I must have canceled myself here, right? So as you can see, it started to go down, right? But if it's above 50, you see an expansion of the economy. Unfortunately, China's headed down, and that's because of the lockdowns that they're having, which means a contraction. We also know about the Evergrande crisis. It's very hard to look at China's numbers. They're not as reliable as the United States, and it's I believe they are undergoing a financial home crisis, right? Real estate crisis, but they're covering it up really well and surviving through it. But from the looks of it, China's struggling. Also, Europe is struggling. And the battle of who falls first is essentially what countries are fighting for right now. Okay, and these are the problem with China going down and closing out its export through the zero tolerance policy for COVID is that it's hurting emerging economies. This is not good. And as the dollar increases, it hurts the currency of other countries. I believe, correct me if I'm wrong, Lebanon just filed for bankruptcy. And this makes a point for crypto, as Venezuela went to crypto to help. A lot of Ukrainian people are turning to crypto. Even the Russian government is starting to turn into crypto, right? And they're starting to help their rubles by making oil purchases through that. But what's interesting here, and very quite frankly sad, is that with nitrogen levels, which is essentially distributed from Russia, farmers are having a tough time right now. 15% of global wheat supply is coming out of Ukraine and Russia, even more, quarter, right? That's all gone right now, guys, right now. Farmers have, Ukrainian farmers are not going to go out there and plant and be able to do what they need to do to supply the world when there's bombs over their head, right? This is going to be very bad, guys, and this is going to cause a lot of starvation, not so much in the United States as a lot of countries that have purchasing power are buying up all the supplies right now, but countries like Africa that are developing, there's going to be a lot of starvation, and this is going to be extremely painful, okay? We left one catastrophe with COVID, and now they have, just suffering all year long for the next couple of years, honestly. I hope that we can get through this, and I hope this war ends and we can reach a resolution. But from what it looks like it, as what Putin said, the discussions are dead in the water. So I definitely pray for all the people out there. I wish I can provide a better world for you guys. These numbers are depressing to look at this. If you look at the Consumer Price Index, this is the OECD, which measures the inflation of all countries. And as you can see, this is the breakdown of all of the countries that it looks at here. But what you can see here, this is the bigger problem. And if you were to take a look at inflation and all the monetary policy, almost like a house, right? United States house is damaged, right? But it's still the best house on the block. Other countries are struggling right now. So, U.S. is doing really good right now. We're still leading. But it's, again, how long? That's the question, right? So, as you can see in this figure here, U.S. is leading the inflation here. And when you look at durable goods, we're leading it by a lot here. We're in red, as you can see right there. And that's not good, guys. This is through all of the Federal Reserve overstimulated economy through the monetary stimulus, a.k.a., the printer go burr, the memes that we saw. This is the result of it. And I don't want to go too much in the political route, but that's good. That bill that did not pass. Imagine if they printed more money. We would be at a very, very bad position right now. Okay, so how do we fix this? What is the end of this? What's going to happen? Well, if you look at the Consumer Price Index since 1921 all the way up until 2022, every time we had a high max point for inflation, we got a recession. We got a max point here, we have a recession. Max point, recession. Max point, recession. Max point, recession. Max point, recession. Okay, we're at a max point here for a while. I mean, the data is very clear. Recession. And whoever tells you otherwise, that's what this data is telling me. That's the best way. But Federal Chairman Jerome Powell wants to do a soft landing. Okay, let's see if we can do it. But from the data, highly unlikely. So if you look at used car prices, they have come down. They're still oscillating. I think they're going to be hovering around this specific region here. So people that have sold their used cars, they've expected it. They're very excited. Kelly Blue Book and all that. You guys are realizing that even CarMax is buying your guys' cars at a higher price. And how long will that be? Who knows? But definitely should come down. If you look at the consumer credit outstanding, it is increasing. This is due to student loan. A lot of, for example, SoFi has been hurt because of President Biden extending the student loan a couple more months. And what's interesting here that I want to point out is the personal savings is really almost at, honestly, not even almost, it's at all-time highs, guys. We're at approximately $2.6 trillion of personal savings that's just waiting to plow itself in the market. And once we finish off the whole geopolitical problems with Russia and Ukraine, and then the inflation is at bay, guys, we're going to be in a crazy bull market, okay? And this is what Cathie Woods is gunning for. This is why she's saying she expects an average return of 50% compounded year to year. And I expect that even as well with my portfolio, and I think it's going to be tremendous, right? And it's because all this cash on the sidelines, wanting to see what are the winners, right? Everyone's a genius during a bull market, but it takes a skilled investor to strategically give themselves the opportunity to buy stocks that are discounted through the intrinsic value calculations that we create. to essentially set themselves up to become wealthy in the future. So your future self can thank you for the decisions that you make in today's present value, right? So there's that. Unemployment claims here are really impressive. I mean, guys, we're at lows that we've never seen. The writing is on the wall. The Federal Reserve is going to increase by 50 basis points. 25 no longer. It's time to rack up those interest rates. And again, you don't want to do too hot because it will trigger a recession. And that's the battle that the Federal Reserve has to find. You know, that I do not want to be in his position right now. Okay. This is the 2-year Treasury yield and the federal funds rate. Again, the 2-year is in red and the federal funds rate is in blue. Usually, the federal funds rate tracks with the 2-year. So it's important to look at that, and this will give us the future prediction of where the federal funds rate is going to be. Now, what's interesting here, this signifies no recession. But if you look at the 10-year minus the 2, and I'm sure you heard about it, inverted yield curve, you can see that this is inverting, which means that, yes, that is signifying a recession. However, what's on President Biden's desk through the economist that he hires is actually the 10-year minus the federal funds rate, and that's signifying no recession. So we're basically getting a graph that looks like this. No recession, recession. And everyone is stuck scratching their heads. Kathy Woods is scratching her heads. Chamath is scratching their head. Everyone's scratching their heads. I'm scratching my head. I've never seen this before because usually these track together. Look at here. They both fall down. You got a recession. They both fall down here. And look at that. A couple, 2 years later, recession. They track down, recession. These are leading indicators. They tell you when a recession is going to happen. And they're pretty darn accurate. Track down, recession. Track down together, right? They're all together. You get a recession. But now, all of a sudden, we have things going opposite. What in the world is going on, right? And if I had to pick one, I would go with the blue one. That's what President Biden is going with. And that's where all the economists are going with, right? And big money as well. So this is the one that's more accurate. So once this starts tracking down, recession. Okay, so now let's take a look at the 10-year U.S. Treasury bond yield here. And let's do some education, okay? So if the bond rates continue to increase, the bull market, let's say it right now, it's done. It's over. We're going to be in a bear market. However, if you draw a line here, guys, it's kind of very clear. We're in this kind of downward trajectory, right? Let me just shift out of this and delete this really quickly. But let's just pretend that we're in the 80s right now. And let's just say if YouTube was, in the 80s. What I would be telling you right now, if we're at this time point, is I would say, guys, screw the stock market. Go into bonds, right? They're paying a lot, right? This is guaranteed money. Now, it's interesting here. You might ask me why? Because Chapter 2 of The Intelligent Investor says that, inflation versus bonds. Well, stocks versus bonds. Stocks overwin bonds because, we're in an inflationary standpoint. Companies can increase prices like Diet Coke here. Coca-Cola can increase their prices. And let me take a sip. There you go. Their profit margins can outpace inflation. And your stocks that you own for Coca-Cola, you win. But the problem is when bonds increase like this, the stock market's done. That's when Paul Volcker came in, a true American patriot, if I have to say, and just literally crashed the economy here. And I have to tell you guys, with this whole CPI that was pumping up here, crashed the economy, and boy, was it really good for our society. We would not have had a strong stock market in our country without Paul Volcker. So God bless his heart. He passed away, but a true American patriot. So the Federal Reserve has to have the might in them to do the same. And it's going to hurt a lot of people, but I will tell you, the pain will be temporary. So this is kind of just give you some education. We'll talk about it in the Mastering Stock Market course. But, I'm trying to set you up for all market conditions and looking at the past. Now, again, I'm starting to hear people in the back here. I'm at a coffee shop, so please excuse the noise here. But overall, I'm looking at everything. This pretty much is it. I'm going to be talking to you guys about part 2, which is more geared to the Clover Health, looking at the support and resistance, a Monte Carlo simulation. But first, I want to talk to you guys about Webull. If you guys haven't done so, Webull just extended their, they said they're going to end it in March, but they went ahead and continued it. Now, this is now until April. So it's no longer ending in March. They just gave us, and I just feel so bad. I wish I told you guys earlier, but at least, what is it? It's been 13 days in the month, and I wish I told you guys earlier, but please listen. If you want 5 free stocks, please sign up using the link down below. You'd get literally almost anywhere between $2,700 to $9,600 worth of stocks. 5 free stocks, and they only used to give out 2. This is a short-term promotion. I think they're trying to battle it out with other companies that are coming in the market, and they're giving out all these stocks. So take advantage. This is 5 free stocks. Imagine if you get almost 10 grand. That'll pay for gas for a couple of years. And again, I'm just trying to find ways to help my subscribers get free money. This is free. All you have to do is deposit 1 penny. And this is also a plug into our Discord. I have to point this out. This was just today. One of our members. These are all the profits that they've been getting. One of our members recently talked about how I can say without, this was literally today at 9:26 a.m. I can say without this data being provided at $9.99 a month, I would not be up $3,000 right now over the last month, because the market has been really rough. And it's true, the market has been rough. And these are all the profits here that a lot of members have been getting. For some reason, I can't click on it. I think this computer needs to be restarted, because a lot of data analysis was happening before I shot the video. So here's our Patreon group. It'll give you direct access to our Discord, and this is if you want Zoom calls with personal with the group here. But yeah, I would love to see you guys on this. We're going to be going in and doing our brain machine, which is going to be amazing. Let me go ahead and see if I can reload this here. There it is. So if you look at our profits here, which for some reason this just doesn't want to show. I've never had that issue before. Well, we'll definitely see what's up with this here. But overall, this is the Discord channel here. I'm trying to see if I missed anything. Oh yes, there. I was like pausing. I was like, there's something that I'm missing. I want to talk to you guys about. Guys, listen. The real estate market is at all-time highs. Okay. Gold is at all-time. Crude oil, all-time highs. Where are people going to put their money in? It's very clear that putting your money in a savings account, you'll be losing. And the people that are putting their money here, all these folks here, guys, they're honestly making a very bad mistake. They're losing a lot of money through this whole inflation. And once they start realizing this, all the side money is going to get dumped back into the market. A $500,000 home with a mortgage will cost you anywhere between $2,700 to $3,400 of monthly mortgage. And let's say in Arizona, the average median household income for just one person is $57,000 a year. And if you take off the mortgage of let's say on average a $500,000 home, they'll only have less than $1,700 available for insurance, for electricity, for gas. Oh my God! So it's very clear that houses are overvalued, and through all the greed that happened when the Federal Reserve pushed down interest rates near zero. And I think that we may endure a correction, but until then, the stock market is the only undervalued place where you can manage your assets. So that's definitely what I wanted to point you guys back on. But all in all, this is all I have for you for this series. The next one we'll talk about the support and resistance and specific market indicators for Clover. And please subscribe if you haven't, and I'll see you on the next one.